Well, the Reserve Bank decided to lower the official cash rate 25 basis points, as just about everyone expected. But the big question going into today was more what the bank would say about the path for the official cash rate from here, what hints it would give us. Now, it turns out there was not a lot in the way of subtle hints. The message was very clear. It was almost up in neon lights. The Reserve Bank recognises that the economy needs a bit more help, and so it's going to cut the official cash rate by more on its forecasts than it had previously signalled, and the OCR will stay at that lower level for a longer period of time. So the Reserve Bank puts out 55 odd pages of analysis, charts, some quite nice photography in its statements, but all you really needed to know from today's announcement was on page 49 in the table there, and that is that an extra 1.5 OCR cuts have been added to their previous May projection, such that the trough in the OCR now falls to about 2.6% odd by the end of this year or start of next. That's down from the previous 2.85% forecast. Now, if that wasn't enough, we also saw two members of the Reserve Bank's Monetary Policy Committee actually vote for a larger 50-point cut in the cash rate today. So that just shows you the extent to which the bank has taken on the fact the economy has been struggling through the middle part of this year. Now, we have been signalling downside risk on the bank's OCR forecasts with our expectation of a 2.75% trough in the cash rate. Following the signal today, we've added an extra rate cut onto our projections, so that takes the cash rate down to a forecast low of 2.5% by November. So what about the risk of inflation? Well, the Reserve Bank certainly hasn't abandoned its post in managing inflation in New Zealand. What it has done is recognise that many of the factors driving up inflation at the moment are, one, likely to be temporary, and two, unduly reflect some of those administered prices rising in the economy. Things like rising bills for rates, electricity, food, government charges generally. Certainly not this type of inflation that reflects a hot or even warm economy, and so shouldn't really stand in the way of lower interest rates. The Reserve Bank was very keen to reiterate its focus on the medium term today. So what does this mean for the economy? Well, I think we're going to see retail interest rates fall a little on the back of today's decision, both floating rates and perhaps those short-term fixed mortgage rates as well. That's because we've seen wholesale interest rates fall today. So I wouldn't necessarily overstate the case, but at a time where the economic recovery was teetering a little, it is going to help assure the recovery that we're expecting for the rest of this year and particularly into next year.